Let's just return to the situation on rate hikes. The big concern for a lot of people is not the rate hike announced, but how many more to come. I spoke to the Australian Banking Association CEO, Bligh, a short time ago.
Yes, I think that was a bit of a surprise to people yesterday. I hope that the early signs that we're starting to see, that the RBA's efforts to pull back inflation are starting to work. I hope that that means that the comments yesterday don't come to fruition. There is a lot of pressure now on mortgage holders, but on the promising side, we are starting to see spending getting reined in a little bit, and that will be something that I know the RBA will be looking at very keenly in future meetings.
Just how much stress is there for mortgage holders? Because, there's reports of this 800,000 cohort facing a so-called cliff. How much do banks know about how much trouble that cohort can or could be in when their fixed rate period ends?
Sure. So, yes, there were a lot of Australians who did the smart thing, and that is they refinanced their loan during the COVID period when rates were extremely low, and those fixed rates will be transferring to variable rates over the next 2 years. But what I would say is that I think the use of the word mortgage cliff is very unhelpful. I think it causes unnecessary anxiety for a lot of people. 800,000 sounds like a very big number, but it is by far the majority of those people. Banks can see already they're months ahead in their mortgage. They have significant savings in their savings account. Their offset accounts are looking very healthy. There's $236 billion in mortgage offset accounts in Australia today. That's a lot of buffer for a lot of people. It's not for everybody. There are people who are going to find any further interest rate rises very, very tough. And banks are already looking right through their mortgage book and identifying those customers who they can see are starting to find things difficult, who they can see will be coming off their fixed mortgage in 3 months or 6 months, and they're talking to them now. There are things banks can do. They learnt a lot managing these situations at scale during COVID when they had to transition 900,000 people off deferred mortgage payments back into payments. And they did that without anyone falling off a cliff, and that's what they're aiming to do this time.
So COVID was this really special situation. People really had no warning and a massive number of people were out of a job. This time it's more traditional, right? We've got interest rate hikes that are occurring. Is this being treated just as a normal interest rate increase period, or is it a special situation similar to COVID in your view?
Well, I wouldn't say it was, special in the same sense as COVID was, but it's fair to say that, neither customers or banks have experienced interest rate rises before May last year for a decade. We've seen 10 years of interest rates dropping. So it's a muscle that hasn't been used for a long time. And banks are having very explicit discussions in their lending teams, in their hardship teams, about how to make sure that they can help manage people or help people manage their finances through this period. Because if the RBA's pulling of the monetary policy levers starts to work throughout 2023, then we can anticipate that interest rates will stabilise and then at some point start to drop back a little. So banks see this as a period of time during which those customers who are really struggling will need extra support to get them through that period. Banks treat foreclosures as an absolute last resort. And at the moment, no one's taking comfort from this because we're only probably halfway into this process. But during November and December, bank default rates on mortgage payments actually reduced. It went down, and it's still lower than it was in 2019 before COVID. So people are managing at the moment, but we're all very conscious that there's a lot ahead.
And I'm sure it's all being very closely monitored, fed back into the RBA and so on. We've seen interest rates go up and mortgage rates go up, and that's the point of them passing on. So I know there's been some criticism there. It makes sense from where I'm sitting. But what about deposit rates? They haven't been going up at the same rate. Why not?
Well, of course, anybody who's a saver, who is particularly those who are relying on the interest on their savings to support them in their retirement, they've had 10 very lean years. And quite rightly, they expect that now that interest rates are rising, they will start to see significant improvements in the returns on their investment or their savings. What we have seen in the last, since May last year, this time last year, in February last year, there was not a single major bank that was offering anything more than 0.3% on their savings products. As of yesterday, I couldn't find a single bank that was offering anything less than 4%. So in whatever it is, 10 months, it's gone from 0.3 to 4%. And there are certainly other banks.
That depends on the product, though. I mean, 6-month term deposit rate is between 2 and 2.5% with a cash rate at 3.1. So they're the big four banks. It depends what product.
Well, that 0.3 and the 4% was the same product comparison. But yes, you're right. There is always a difference between the rate on savings and the rate that is charged to borrowers. That is the margin on which banks operate. So we're never going to see them identical. What I think customers are entitled to do is to see them increasing. But there is an ACCC review looking at this at the moment. So I would expect that when we see the report of that review, we'll see a much clearer picture of what's actually happening out there.
Anyway, we're going to end it there. Anna Bligh, thank you for your time.
Thank you.